TFI International has produced big returns for shareholders in recent years. Of course, that stock has slid lately. There are problems in the US operations. And then the trucking company said it planned to move its HQ to the US. Apparently, though, there was pushback from shareholders, and Alain Bédard, the CEO, has dropped that plan. Our guest, Brian Madden, Chief Investment Officer at First Avenue Investment Counsel, is bullish on TFI. Start off, you see value in this stock after it's come off the boil.
Absolutely, Andrew. This is a company that has just gone through its fifth biggest peak-to-trough drawdown in 35 years of trading. And let's not forget, this is a massive growth compounder in what really amounts to a fairly low organic growth industry. It's just a great serial acquirer, and it's been, I believe, 160 bagger since the turn of the century. So with the shares trading off 42% since mid-December, if you can imagine, this is a great time to be entering a position if you don't have one, or adding to an existing position. The shares are discounted versus their peers significantly by about 40% if you look at PE ratios, and also discounted versus its own historic 5-year average trading multiple. Right now it's trading at about 14 times earnings, and it tends to grow and compound earnings through serial acquisitions at a high teens rate. So exceptional combination of growth and value in these shares right now.
I'm just looking at the return this century, something like 16,000%.
Huge, yes.
Yeah. It sounds like they have had problems with some of the business they picked up from FedEx.
Well, UPS actually.
UPS.
Yeah, they bought the less than truckload operations from UPS for about $800 million just about 5 years ago. And it was, admittedly a bit of a fixer-upper operation. It was small and non-core, not well managed at UPS. And they were starting to get after fixing it up. And then, of course, COVID hit and no one could buy services and everyone was buying goods. And so that sort of delivery and fulfillment skyrocketed. And they had a few years of tough comps. But still, 5 years on, what they now call T-Force Freight, by his own admission, CEO Alain Bédard says they've got some work to do there. And primarily it relates to changing the sales culture so that their salespeople are incentivized to sell more profitable freight rather than just more freight. You don't want to move a 1 pound box 50 miles if you can move 1 ton 3 miles. It obviously makes much more sense to have density on your routes and on your network. So they're working on that. But cultural change is slow and incremental, and this one has been challenging.
Looking at the broad markets, they're trading near record highs, and you reckon there's a bullish mood in the markets despite any gloomy projections over inflation and tariffs?
Yeah, for sure, Andrew. At First Avenue Investment Counsel, we're firmly in the camp that the bull market that started in late 2022 is very much alive and well, notwithstanding there's the proverbial wall of worry to climb over. But if you give a scorecard, we'd probably score the U.S. market measured by the S&P 500 as being a healthier bull market. And that's because it's been making a series of higher highs and higher lows. And you can see that on the chart there. Whereas if you turn your attention to Canada, the S&P TSX Composite has been making an iterative series of higher lows, but has failed to break out past the higher highs that it made in, I believe, late January or late December, early January. And not surprisingly, because Canada is obviously, in the crosshairs of the United States with tariff risks front and center.
Right. Would you be inclined to avoid Canadian stocks, generally speaking, right now, Brian?
No, Andrew, on the contrary. We think the Canadian market is setting up to be a fantastic opportunity. You think about what could go right, which is what you want to do as an investor. Shareholders own the profits in the economy, and the economy grows inexorably over time, regardless of who's sitting in the PMO office or the White House. And so you have a market or a country where the currency, by any account, is demonstrably undervalued relative to most estimates of fair value, which would be, around $1.13. We're at about $1.42 now. Or even the 50-year average, exchange rate for the Canadian dollar, US dollar, which is around $1.23. So a foreign investor looking at an investment in Canadian equities could pick up a nice currency kicker in addition to the local market return. And you have an ingoing valuation disparity against the U.S. market that is historically almost unprecedented, with the TSX trading about 8 multiple points discounted to the S&P 500, despite very similar expected earnings growth this year. Couple that with likely change in federal leadership that can realistically only go in one direction, which is to say more pro-growth, more pro-investor, red tape reduction, smaller government, and monetary stimulus. It's setting up to be an almost perfect storm, frankly.
I don't know if you remember that show, the comedy show Yes Minister on British TV back in the 70s or 80s, but it highlighted how it's very hard to cut back on bureaucracy.
Well, yeah, I mean, we have a rather unconventional effort underway in the United States to do just that. Proverbial bull in the china shop, so we'll see how that goes. But yes, it is difficult.
Any thoughts on BMO? They did beat expectations in the latest quarter.
Yeah, I've been up to my eyeballs in that already this morning, since they reported at the crack of dawn. Excellent quarter. I think their management team is very good, very credible. They were pretty adamant that they were past the peak of the credit losses last quarter. They are. Beyond that, good revenue, great quarter in wealth and capital markets, amazing efficiency ratio progress. So they're doing a lot of things right here, Andrew.
Yeah, we're going to have more after the break on banks.